Good afternoon. This is Brian Shannon from Alpha Trends Blogspot. It's Thursday, June 7th, 2007, and we had quite a little bit of a sell-off here today in the S&P 500 and the other markets. The spiders were down $2.50, 1.7%. This is the biggest sell-off we've seen since February. And yesterday I pointed out that the 20-day moving average had been violated on a closing basis for the first time since back in here, which was March 16th, and I was pointing out that a lot of times the market does pull back then to a 50-day moving average. I definitely wasn't expecting it though, but here you can see that that 50-day moving average is just down at about 149, and we sure did come close. So the market's continuing to sell off a little bit here in the after hours as well. I see out of the corner of my eye. So it looks like we're headed for that 50-day moving average, and you might even look at it and say it's being touched as we speak. 48.88 is where it looks like. So maybe we're due for a bounce there after a sell-off in the morning. We'll see. But a lot of times that 50-day moving average does act as support. I think the smartest thing I said yesterday is that it looks like it's time to probably take a day or two off of trading and let this market find support rather than try and pick a bottom to wait and stand on the sidelines and wait for things to get better as the market shows us evidence. Yesterday there was no evidence. We saw that that 153.50 level that we were hoping to be support was violated, and then that acted as resistance. That was 2 days ago actually, and then the 152.50 level. From there the market looked like maybe it was trying to find support at a 61.8% retracement of this move. But as I pointed out yesterday, the danger is in trying to pick bottoms. No one can do it successfully. And what we want to see is an alignment of trend. I pointed out on the 30-minute time frame that perhaps this trend line would hold as well. That obviously didn't. But what I was looking at also, and you can see here that we do have a lower low. So our uptrend for now is broken, but we're going to continue to give the benefit of the doubt to the buyers and look for a bounce because this rising 50-day moving average and the severity of the sell-off here that we've seen over the last 4 days. So back to the 10-minute time frame, zero evidence that this market's making any attempt at a bottom. We've got lower highs and lower lows, and certainly there's a lot of fear in this market right now as the sharpness of the sell-off indicates. But let's wait until we see, like I pointed out yesterday, that this 5-day moving average can at least begin to flatten out. So I'd suggest that tomorrow is another great day, except for very aggressive traders, to take off and enjoy a nice early summer day. But anyways, the S&P 500 did sell off, and what we want to continue to do is wait for the buyers to take control. We want to have an alignment of trend. We don't want a downtrend on the short-term time frame and then an uptrend on the daily time frame. We want an uptrend on the daily time frame and an uptrend confirmed on a short-term time frame. As we got bullish over here on the 30th, we saw that it did follow through. Then we had distribution, and then now we're in the decline phase. It's definitely a fear-driven sell-off right now and is overdue for a little bit of a bounce, but only the most aggressive traders should attempt that. Otherwise, you're going to end up getting chopped up, paying a lot of commissions, trading back and forth, and that sort of thing. The Nasdaq 100, also yesterday we were looking at this one, saying that it needed to get back above 47.40 before the buyers really could be considered back in control. We were looking for support at the 46.80 level. That failed to hold. We had an afternoon rally come up towards that level, which failed to. So we've got this market breaking down, the Nasdaq 100, and it's once again back into this range with 46 as support, as a potential support level. We never know where support is, which is again why it's always dangerous to try and buy at what you perceive to be a support level. What you believe is support might not be confirmed by the rest of the market, so we want to wait for evidence of buying in that level, at least that this sell-off has run its course, and then we want to see the shorter-term moving average crisscrossing the 5-day moving average start to flatten out like we saw over here, and the market get back above that 5-day moving average. So that's what we need to see. That's not going to happen in one day. So again, the best bet here is to sit on the sidelines because we've got a short-term downtrend, and again, only the most aggressive traders should attempt to play any kind of bounce in here. But right now it looks like that 46.80 level is going to be a potential level of resistance going forward, and on this daily time frame we've had two failed moves past this little 47 range. That could be setting up something more significant. I don't want to call for anything big here, but you can look at this trend line as broken too. Again, trend lines don't mean reversals. They mean that maybe we're going to get a correction more through time rather than price. But this market is starting to get a lot more worrisome to me, and I think it's speaking loudly that we have to really pay attention here. The semiconductors. This group is looking like a real mess in here right now, and it did break down and close below that 36 level. Yesterday I said that we want to look at maybe a shakeout down towards 36.50. It did hold above that level. It doesn't make me bullish because, like I said, when I exited those call positions last week, that it looked like it made a short-term target at the 37.20 level, and then we've got a short-term downtrend. So there's nothing here that indicates it's time to purchase. Let's let other people do the dirty work. Let them find the support for us, and then when it gets safe to enter, then we'll know it, because the charts will slowly start to turn, and that's the time to get involved, not now. Not to guess that any certain level such as 36 is going to hold a support. Again, that's just guessing. Disciplined trading and professional trading is not about guessing. It's about having the odds in your favor and waiting for those low-risk setups to occur, and having the discipline to sit on your hands while they're not there and while they're setting up. So knowing when to be out is just as important as knowing when to be in. Like there's a saying that goes, it's better to be on the sidelines wishing you were in a market that's running away than wishing you were out in a market that's declining. And I think a lot of people are wishing they were out here right now. But the IWM also showing troubling signs here as it broke down through that what's been a very important level at 83 here for the last several months. Broke down through there very hard. Now I think that level, we can view it as, once again, as a potential resistance level. We do have this trend line and the 50-day moving average, so I think that we're probably due for a bounce in here in the short term. But guessing where that's going to occur is anyone's guess, and that's all it is a guess, because right now we've got these lower highs and lower lows, and we've got all these moving averages heading lower. So again, best bet for tomorrow is to take the day off, I'd say. Let's look at what's been called the culprit of this sell-off, which is the 10-year bond yield. This is a chart of the yield. This is 47 means 4.7%. 50.99 equals 5.099%. And you can see that these yields have been in an uptrend here for the last 3 weeks or so. But for today, for some reason today, this is being assigned as the reason for the sell-off. If we look at the weekly time frame, we can see here that it's broken past what looks like an important resistance level. Notice here how the 40-week moving average is heading lower at this point, and that move didn't hold. But now that that 40-week moving average or 200-day moving average is flattened out, now this rally looks sustainable. To me, it looks a little overbought. Perhaps we'll see it pull back down towards 490 or so now that it's part of mainstream reason for the sell-off. You know, I would expect probably a pullback down towards 490. People stop talking about it, and then it sneaks back up again on us a couple weeks later, as people forget about, you know, what happened 3 weeks ago when that sell-off occurred. I'm talking in the future there, if that makes sense. But we've got you know, this longer-term chart in the 10-year notes showing that perhaps that 520 level is pretty significant, and you could look at this as a multi-year maybe cup and handle. Breaking past 520 or so could be big problems for the bond market, and that could in turn sour people's opinions on the equities as well. I don't want to make these macro bets. Let's just focus on what we're trading. I only bring up the 10-year bond note because that was getting a lot of attention today. Meanwhile, hey, enjoy your day off tomorrow.